Well, what we did see was last Thursday, of course, was a gigantic shakeout. And at the moment, as it was happening, or certainly on a Friday, I said on that video recording in the room, I said this just has to be a shakeout. And why did I say that? Well, because at the top there, the market had been going sideways for up to 3 weeks. It was having great difficulty in making any headway. Every time it tried to go up, there was narrow spreads or no demand. It just wasn't going anywhere. So the professional side of the market, I think, is mainly the market makers and people on the floor. Don't forget, it's a cash market that drives these markets. It's a cash where the equity lies. Not the future, but remember, of course, that the professionals are trading, trade the cash market will also trade the future, and they know that when they do certain things in the cash market, it's going to drive the price down or up, and they will jump into the futures and trade that almost before it happens. I know this goes on, definitely, and therefore some people get the wrong idea that it's the future driving the market. It's not. It's actually the underlying cash. That's where the equity lies. And but anyway, on the Friday, we definitely said this just has to be a shakeout. Why? Because the market needs these shakeouts periodically. You'll find it happens time after time. You know, it may not happen for a year or so, but when it does, it'll hit you like it did, very suddenly. It was plummeted down to the low, but the volume was massive. The computer said it was ultra high, and it closed in the middle. So by doing that, okay, sorry about that. We should unplug the phones in the office. Sorry about that. But anyway, the market plummeted down. It recovered. Look, that was the key to it. It recovered way above the halfway mark. And look at that massive volume, ultra high volume. Now, if that volume had been selling, how can it close up there above the middle? It's impossible, isn't it? If that was all selling, that would have plummeted down, at least close on the lows. So it has to be a shakeout. Now then the next bar, which is there, look, Friday, that's it, Friday. Again, we've got a down bar, but note how the spread has narrowed relative to the Thursday. And also note, closed well off the lows, look, almost in the middle. And again, the volume is almost as high as it was the previous bar. That has to be buying. It cannot possibly be anything else. Professional money is saying, right, and in they go and they buy everything they can get hands on because they know it's a shakeout. But you'll never be told that. The exchanges know perfectly well it's a shakeout, but they'll never put the news out and say, look, don't worry, this is a shakeout. We know this because all our dealers are busy buying. They never tell you that. So there you go. You have to know. It's a Wyckoff principle, no question about it. So Thursday, Friday, and then consequent to that buying, right, Monday it gapped up, look, widespread up, close on the high. That's fine, but look at the volume. The volume has dropped off down here, look. Now the computer automatically colors it red, I suppose. I don't know what color that's supposed to be. Pink. When the volume is less than the previous two bars. Now remember that when weakness appears, it always appears on up bar. And when strength appears, it always appears, look, on down bars. Always remember that. So here we've got a widespread up, close on the high, and the volume's dropped off relative to the previous volumes. Okay, so it's Monday, that's understandable, but there's a certain amount of no demand in there, though. Okay, now the next bar here, didn't really go anywhere. It tried to make a bit of an effort up, but again the volume is low. That's why it was unable to go anywhere completely. And the same with that bar, look. The volume is low. It's trying to go up. Now what I'm saying is that it'll follow Shakeout principles. Sooner or later they'll want to test. When that price, which I'm sure it would do because of this has to be buying here, back down here. Now I think, yeah, he has. Peter's drawn a line across here. Look, the close of that bar. That's green, isn't it, Peter?
Yes.
A green horizontal line. If and when that price hits that, which it might very well do quite quickly, and the volume is low, relatively low to all this volume here, then that market will go up, and it'll go up for the simple reason is that if they mark it down and the volume is low, what it means is there's no selling pressure from the professional side. They are not interested in lower prices. And the market works without question on the balance of supply and demand, which is going on. And when the market sees there's no selling pressure, it just shrugs its shoulders and automatically says, right, the path of least resistance must be up, and the way it goes. That's basically how it works.